everyone, and welcome back. We are diving into the fascinating world of index funds today with the book that basically wrote the book on index funds.
It's true.
John Bogle's The Little Book of Common Sense Investing. This book is, it's practically a Wall Street legend at this point, and with good reason.
It is. It really is.
Yeah.
And I think Bogle's brilliance is really his ability to explain this often sort of intimidating world, right? The world of investing in a way that everyone can understand.
Totally. Like, he's pulling back the curtain and saying, like, hey, it's not as complicated as they make it seem.
Exactly.
And one of the things that really stuck with me, and I know you've read the book too, was his got rocks family analogy. What stood out to you about that?
Yeah, it's such a powerful way to illustrate kind of this fundamental principle of investing, right? And so imagine this. You and your entire extended family own all the stocks in America.
Yeah.
Every share, every company, you name it, the Gottschalks have it.
The
Gottschalks, that's right. They own it all.
Yeah.
And that's essentially what owning the entire stock market is like, and it's what index funds, aim to do.
So, okay, let's unpack that a little bit. So we're all part of the Gottschalks family. We're all invested. Things are looking good. But then what happens?
Well, just like with, like any family, some members, they get antsy.
What?
They see others making moves, buying and selling. They want in on the action. So these are like your active investors, right? Always chasing the next hot stock, trying to time the market. But here's where it gets interesting, right? Bogle points out that all this trading, all this trying to outsmart each other, creates what he calls costs.
Costs. Like, you mean like brokerage fees, commissions, all that stuff?
Exactly. So every trade comes with a price tag.
Right.
And those fees, those seemingly, small percentages, they add up big time, especially over time.
Yeah, and this is where I think that Gottschalks analogy really hit home for me. Because you think about it, every time you pay a fee, you're essentially giving away a piece of your family's wealth.
That's right.
A piece of your potential future returns.
Precisely. It's like, some of the Gottschalks are like handing over chunks of their inheritance to the very people who are helping them trade, these brokers.
Oh, interesting.
Yeah. And this is why Bogle argues that the stock market is a zero-sum game before costs.
Okay.
For someone to win, someone else has to lose.
That makes total sense. So how does this all connect back to index funds?
Well, so this is where I think, Bogle's genius comes in. He says, instead of trying to beat the market, right, by constantly trading, why not be the market? And that's what index funds allow you to do. They basically track a specific market index, like, the S&P 500, for example. So you're essentially buying a tiny piece of every company in that index.
So instead of betting on individual horses, you're betting on the entire Kentucky Derby.
Exactly.
Okay, I like that.
And that's where most of the beauty of index funds is this simplicity through diversification. You're not relying on any single stock or trying to predict the market's every move.
Right.
You're along for the ride, essentially.
You're in it to win it.
You're in it to win it. That's right.
And because they're not constantly buying and selling, they keep costs low, right? Which is where those like pesky expense ratios come in.
She got it.
Yeah.
You see that tiny, tiny percentage next to the fund?
Right.
That's the expense ratio. And it represents the annual fee that you're paying to, basically be a part of that fund. And don't be fooled by how small it looks.
Right.
Over time, it can like eat a huge chunk out of your earnings. Think of it like a tiny leak in your boat, right? You might not even notice it at first, but ignore it long enough, and you might find yourself slowly sinking instead of sailing toward those financial goals.
Okay, that's a scary and too accurate analogy.
It's true, though.
So with these index funds, right, we're talking lower fees, broader diversification, sounds like a no-brainer. But Bogle also presented some pretty compelling data to back this up too, right?
Absolutely. So he dug deep, decades of market data and found that low-cost index funds have consistently outperformed the vast majority of actively managed funds. We're not talking about, a small margin here. This is significant.
Yeah, there's that one stat in the book, I think he said you basically have better odds of winning the lottery than picking a winning fund. It was pretty mind-blowing.
He did, yeah. It really highlights just how difficult it is to consistently beat the market over the long term, even for the pros.
Wow.
Right? So many factors at play. Luck, skill, timing, and of course, as we've been discussing, those pesky fees all play a part.
It's like trying to time the waves while surfing. Sometimes you catch a big one, but more often than not, you're getting tossed around and losing ground.
Exactly.
Yeah.
And just like, learning to surf, takes practice and patience. Investing does too, and having, a good understanding of the dynamics involved.
Mm.
And I think what's great about Bogle too is he doesn't just talk about the numbers, he digs into the emotional side of investing, which I found incredibly insightful.
Yeah. No, that was a big takeaway for me, too, because he talks about how we're practically wired for speculation,
We are.
even when it works against our best interests.
It's
Like, why do we do that to ourselves?
it's exciting, right?
Mhm.
Like the thrill of the chase, the, dream of outsmarting the market. It's alluring. But what Bogle reminds us is that investing should be about making rational, informed decisions, not emotional ones.
So how do we overcome that urge, like that urge to chase the next hot stock tip or jump on the latest investment bandwagon? Like how do we block that out?
Well, Bogle really emphasizes the importance of having a plan, a well-defined investment strategy, and sticking to it no matter what the market throws your way. He's
Yeah.
a big advocate for what he calls a stay-the-course mentality.
Which is easier said than done, right? Especially when you see like your portfolio taking a nosedive during a market downturn.
Absolutely, and that's where discipline comes in, right? You know, remembering that investing is a marathon, not a sprint. There will be ups and downs. But by riding out those fluctuations, you give yourself the best chance to achieve long-term success.
This makes me think about another point he made about the importance of tuning out the noise,
Yes.
which is so hard these days.
Oh, I know. It's so easy, especially with 24/7 financial news and, endless market predictions. It's very, very easy to get caught up in the frenzy. But Bogle, he urges us to ignore the hype, block out all that noise, and just focus on our long-term goals.
That actually sounds really freeing.
It can be.
But he doesn't just tell us what not to do. He offers some pretty practical advice too, like setting up 2 investment accounts, serious money and funny money. Can you elaborate on that a bit?
Yeah. So it's actually brilliant in its simplicity, right? So the serious money account is for your core investments. We're talking retirement, your kids' education, those big life goals. This is where you stick to your plan, you minimize those costs, and let those index funds, work their magic over time.
So slow and steady wins the race, basically.
Exactly. But then there's the funny money account. This is, Bogle recommends just a small portion of your overall portfolio, say, 5% maybe.
Mm-hmm.
But this is where you can kind of, indulge in a little speculation.
So you're saying it's okay to scratch that gambling itch as long as we're not betting the entire farm on it.
Precisely. And I think this is a great way to kind of, it allows you to explore maybe individual stocks, dabble in some sector funds, try out those, new investment strategies that everyone's buzzing about.
Yeah.
Yeah.
Have a little fun with it.
I love that because it takes the pressure off of it,
Yeah.
because you know that you've got your serious money working hard in a diversified low-cost index fund, kind of chugging away.
Exactly.
And you've got this little side bet over here.
It's a way to kind of have your cake and eat it too, right?
Right, right.
And I think it goes back to, Bogle understands that we're human.
Right.
And sometimes we want to play the game even if the odds aren't necessarily in our favor.
That's what makes him so relatable, I think. Because he's not just this financial guru up on a pedestal.
Mhm.
He gets it. He understands human psychology.
He does.
And he uses that understanding, I think, to really guide us toward making, smarter decisions with our money. But, moving on from funny money, Bogle also digs into another aspect of investing. We've talked about it a bit, but I think it's worth diving a little deeper, and that's costs. And I'm not just talking about expense ratios, but
Yeah.
he goes deeper into what he calls the often overlooked costs of high portfolio turnover.
Okay, so break that down for us a bit. What's the big deal with a fund, constantly buying and selling stocks? Like, on the surface, that sounds kind of exciting, doesn't it, right? Like, are we missing out on something?
Well, not so fast. Think of it like this. Imagine, you're constantly buying and selling furniture in your house.
Okay.
You're probably going to lose money on each transaction, right?
Really? Probably. Yeah.
And it's a hassle.
Totally.
High portfolio turnover is kind of similar, right? It leads to more fees and potentially lower returns because you're not giving those investments time to, really grow.
Right.
Every time a fund manager hits that buy or sell button, there are transaction costs involved.
Oh, right.
You've got brokerage fees, bid-ask spreads. Even just the impact of that trade on the market price itself can eat into your returns. And a lot of times, those costs, they're kind of hidden.
Oh, really?
You don't always see them as like a separate line item on your statement, but they're chipping away at your returns nonetheless.
It's like death by 1,000 paper cuts.
Ooh, that's good.
Each one seems so insignificant on its own, but like together it can really bleed you dry.
That's a really powerful image. And I think it highlights why Bogle stresses the importance of looking beyond just those obvious costs, right?
Yeah.
And understanding the long-term impact of what can seem like very small fees. And he uses this really compelling example in the book.
Is this the one where he compares the market return, like with and without fees?
Yeah.
Yes.
Yes, exactly. So imagine, right, the market averages an 8% return over, say, 50 years.
Right.
Reasonable assumption, historically speaking.
Right.
Now, let's say the average mutual fund charges around 2.5% in fees. That leaves you with a net return of just 5.5%.
Okay. Doesn't sound like a huge difference on the surface.
Right. It doesn't sound like a lot, especially when you think 50 years, that's a long time,
Yeah,
right?
right.
But here's the kicker. Over those 50 years, a $10,000 investment in the market, earning that 8%, would grow to almost $500,000.
Wow.
469,000 to be exact. The same investment in the average fund, with that 2.5% fee, only reaches about 150,000.
Wow. Okay. That's a massive difference. You've officially made costs less boring.
They're important.
A whole lot scarier.
It's not about scaring anyone, but
Yeah.
empowering them with the knowledge
Yeah.
to make really informed decisions. And I think that's what Bogle, that's his whole thing, right?
Right.
He wants us to understand that costs really do matter. They compound over time, just like our returns do, but on the negative side.
Yeah.
So the higher the costs, the less we get to keep of, our hard-earned money. And that's especially true when you start to factor in things like taxes, right?
Oh, right. That's another hidden cost a lot of people forget about.
Absolutely. It's death and taxes, as they say.
Right, right. But didn't Bogle say that there was like a way to at least like minimize the taxman's cut when it came to investing?
He did, and it actually circles back to those index funds we were talking about earlier.
Okay.
Because they trade less frequently than actively managed funds, they tend to generate fewer taxable capital gains.
Oh.
So more money stays in your pocket.
Okay, so we're talking lower fees, built-in diversification, potential tax advantages. It's no wonder these index funds have become so popular. But what about, like, those of us who still want to kind of explore other investment strategies, or maybe we want to be a little bit more hands-on with a portion of our portfolio?
Yeah, and Bogle understood that impulse, right? Like he'd seen countless investors over the years get, seduced by the latest market trends and hot stock tips, only to end up with, a serious case of buyer's remorse. His advice: stick to the basics.
So no need to, like, overthink it. Just keep it simple.
Exactly.
Yeah.
And when it comes to simplicity, nothing beats a broadly diversified index fund, right? Remember the Gottschalk family.
Yeah.
Investing in an index fund is like owning a small piece of every business in that family. You're not betting on any one company or any one sector. You're betting on the overall growth of the market.
It's that whole a rising tide lifts all boats philosophy.
Precisely. And remember, he also understood that people, we enjoy the thrill of the chase,
Yeah.
the possibility of beating the market. That's why he recommended that, that funny money account.
Correct. Right.
It allows you to scratch that itch without jeopardizing, the long-term financial well-being.
So we've got our serious money working hard in index funds and our funny money letting us play the market without losing sleep at night.
Exactly.
I like the sound of that. But, all this talk about returns and portfolios, it kind of makes investing sound like this purely financial endeavor, right?
Right.
But Bogle digs into something a bit deeper in his book, something that really resonated with me, and that's this whole idea of ethical investing. He seems to really believe that we should align our investments with our values, which I thought was really interesting.
Absolutely. He felt very strongly about that. And rightly so.
Yeah.
Investing isn't just about maximizing returns. It's about using your capital to support companies that are actually aligned with your own personal beliefs.
Yeah, it's like voting with your dollars, right? Like putting your money where your mouth is.
Exactly. Bogle believed that as investors, we have a responsibility to hold companies accountable, not just for their financial performance, but for their social and environmental impact as well.
So, like, if you're really passionate about sustainability, you could, like, seek out companies with strong environmental records. Or if you're concerned about social justice, you might invest in companies that are known for their ethical labor practices.
Precisely. And it's important to remember here that, there are a lot of different perspectives on what constitutes ethical investing. And Bogle wasn't saying that there's one right way to do it. His point was that we have choices.
Right.
We don't have to just blindly hand over our money without considering those broader implications.
So how do we, find those companies, the ones that, really align with our values? Because it feels like a lot to research on your own.
Yeah, it definitely takes some effort. You can start by just, researching companies directly, looking at their policies, their track record, their commitments to, whether it's sustainability or social responsibility, whatever your criteria are. You can also explore investment funds that specifically focus on these areas. You've probably heard of ESG funds.
ESG funds, yes.
Stands for environmental, social, and governance.
Right. I've had that term tossed around a lot lately.
They're definitely gaining popularity. But, as with anything in the investment world, it's important to do your due diligence. Not all ESG funds are created equal.
Right.
You really want to understand the fund's criteria, their investment process, their track record, all of that.
So we're back to, do your homework, be an informed investor.
Exactly.
Bogle would be proud. Well, this has been a fascinating deep dive into his little book of common sense investing. We've covered so much ground. I mean, we talked about the power of index funds, the pitfalls of active management, the importance of understanding those costs, aligning your investments with your values. What's the key takeaway you hope our listeners will walk away with today?
For me, it really boils down to Bogle's core message, which is investing doesn't have to be complicated. It's about making informed decisions, keeping those costs low, staying focused on the long term, tune out the noise, resist those emotional impulses, stick to your plan. And remember, investing isn't just about making money. It can also be about aligning your capital with your values.
And maybe even making the world a slightly better place in the process.
There you go.
I think that's a great note to end on. Thanks for joining us on this deep dive into the simple genius of John Bogle.